Good evening and a warm welcome to all the participants present here today on the Know Your Law Series 57 webinar on outbound and inbound investment in FEMA, organized by the Committee on Commercial Laws, Economic Advisory and NPO Cooperative of the ICI. I, CA Amruta Kulkarni, extend you a warm welcome on behalf of all the participants as well as the organizers. I recognize the presence and really feel blessed to have the presence of CA CV Chitra sir, who is chairperson of this Committee on Commercial Laws, Economic Advisory and the NPO Cooperative of the ICI. Today we have the distinguished faculties with us, CA Amar Goawala and CA Priyanki Lia, who will be sharing their insights on the outbound and inbound investment in the FEMA, and followed by the question answers, which will be shared in the chat box by the participants. Before commencing of the event, I would like to tell you about the committee that is taking many initiatives, and we are delighted to welcome you all for this webinar, which is a 57th webinar of this series in itself. In a short while, we will start this webinar, but I would like to apprise you about the CCLEA and NPO committee. This committee is focused to encourage chartered accountants to shape strategy and policy that unlocks economic, financial, and social value while combining analytical foresight with the commercial acumen. One of the core areas of this committee is to serve the multifunctional task of the analysis, knowledge dissemination, inputs to regulators on policy formulation, to develop and publish technical guidance, background materials, and many more, and also to create awareness for professional opportunities for chartered accountants in commercial laws, economic advisory, and NPO cooperatives. Our eminent speakers will talk on outbound and inbound investment in FEMA in this webinar, and we hope that the same shall be useful to the members. I take this opportunity to thank the chairperson of this committee, C.S. E.V. Chitra sir, for giving an opportunity to be the moderator for the day, and also a wonderful opportunity to hear the insights of the speakers as well. May I please request C.S. E.V. Chitra sir, the chairperson of this committee, to please give his opening remarks. And really, he needs no introduction as such. But to give a small introduction, I would just like to share with you all that he is a member of the Central Council of the ICI from 2019 till 2025. He was in the past chairman of the Ethical Standard Board, Direct Taxes Committee, Peer Review Board. He has held many prestigious positions at ICI and many other forums as well. At present, he is also the Direct Tax Committee chairperson of the MCCI. And I may request Chitra sir for his opening address. Over to you, sir.
Well, thank you, Amruta. It's indeed a pleasure to be with you on this Know Your Law series. Friends, as you are aware that our committee, that is Committee on Commercial Laws, Economic Advisory, NPO, and Cooperatives, has got a very vast canvas. The committee deals with laws, all commercial laws other than taxation laws and corporate laws, particularly Companies Act 1956, 2013, and also the Limited Liability Partnership Act. The rest all acts are addressed by this particular committee. Economic advisory is also considered by this committee. Non-profit organizations, charitable institutions, the parent law relating to them is considered by this committee, and cooperative societies relating to related matters are addressed. So canvas is very wide. This particular series, Know Your Law series, takes care of the various laws with which a chartered accountant is directly or indirectly associated. Maybe if you are indirectly associated, taking cue from this particular presentations, maybe you wish that you are directly associated and participating in a particular area, like maybe FEMA, labor laws, mediation, etc. While this particular session is on foreign exchange or FEMA, ahead of that, let me just tell you a couple of initiatives which are in offering. One is related to labor laws. Now, after 2017 and before 2017, if you look at the field of indirect taxes, there is a sea change as far as the composition of consultants is concerned. Pre-2017, it was major domination by non-chartered accountants like advocates and others, retired employees from department. But post-2017, with the advent of GST, now if you consider today, 80 to 90% consultants in GST are chartered accountants. So similar revolution is or transformation in composition of consultants is likely to take place in 2024-25, and that is in the arena of labor laws. There are three reasons for that. Reason number one is presently the canvas of labor laws is constituted by various labor laws: Payment of Bonus Act, Minimum Wages Act, Payment of Wages Act, ASI, Gratuity, Factories Act, and so on. And besides these laws, maybe there are thousands of notifications which are issued under each of these legislation. So it becomes difficult maybe to enter now and to get abreast with all those legal provisions and notifications. But gone are those days. Now the entire gamut of labor laws will be converged into only 4 labor codes. And those 4 labor codes will govern the entire legislation field of labor laws. So the work is very simple. If you start reading labor laws since inception, maybe you will be able to monitor on those notifications and other things. Secondly, as we qualify as a chartered accountant, we interpret labor laws, we interpret corporate laws. So comparatively, labor laws are an easier bet to take. And I believe that the nuances of our professionals in interpretation, in ensuring the compliance, are much higher than any other professional. So we would be much sought after professional. We would be able to interpret the law in a seamless manner. And thirdly, and most importantly, the entire compliance arena under labor laws is online. And chartered accountancy is the only profession that is today doing the best job of online compliances, be it tax laws, be it corporate laws. So once the era of online compliance starts, I think it would be the field of chartered accountants. So for these 3 reasons, there should be focus on labor laws. Of course, you should have bigger practice, have one person to spare for the purpose of labor laws, or you yourself wish to specialize in labor laws, maybe you should give up your substantial time to study the labor laws. As I said that it would be converged into 4 labor codes. It's not that those labor codes are going to come. Today, they are enacted by both the houses of parliament, and the copies are available online on website. Even books are available. So we can study, and at our committee, we are also taking training programs, planning training programs on labor laws. So that will equip chartered accountants to make foray into the practice of labor laws. Only we are not only focusing the compliance, but we are considering the entire bandwidth of human resource management, HR management, wherein right since recruitment, retention, reward, remuneration, and all those things would be covered, retrenchment, and also training. So once when you enter the field, you should be able to advise, counsel on the entire field of human relations. Second aspect is mediation. Only last year the mediation law has been passed. We are starting a course on mediation, so that chartered accountants, we feel, are the best suited persons for commercial mediation, because on one hand they are aware of law, and on the other hand they are aware of business practices, so they can mediate in a comfortable manner, because the objective of mediation is to conclude the disputes at the earliest possible time, and that's what is the speciality of chartered accountants. We are starting course on that. Only we are waiting because, as you are aware, that the capital for mediation is at Singapore. And if you want to do mediation over there or international mediation, you should be taking course of that Singapore Mediation Center, Singapore Arbitration Center. So we are trying to tie up with them and incorporate those provisions also in our course, so that when a person takes up the course, he is able to do the mediation on global basis. So not only his opportunities are confined to our city or our country, but he will be able to render services across the globe. So these are 2 important initiatives that we are trying. Coming to today's session on FEMA, we have very young and learned professionals who will be informing us about the inbound and outbound investments. They have taken efforts to contribute a book for the purpose of our committee, and soon we are going to release it in our committee meeting on 28th of this month. Maybe we'll invite suggestions of the members, and with incorporation of those suggestions, this book will be released on 28th. So as far as FEMA is concerned, usually when we are practicing maybe in direct taxes, indirect taxes, auditing, and various other fields, we always are consulted by uh, our clientele relating to how to invest in from India, outside India, from outside India, within India, because many persons from India go outside and they always like to park funds in India because this is the most safe haven for the purpose of investment. Today, the rates of interest and also the appreciation in share market is also considerable. But before that foray is made, one needs to understand what are various formalities which are required to be complied with and what are various opportunities that are available. And I'm very happy that Amar Govawala and Priyanki Lia has contributed a booklet on this along with other professionals. And today they would be dilating before you this wonderful world of inbound and outbound investments. So I thank you, Amar and Priyanki, for really facilitating this particular webinar and informing our members about the topic that you are going to discuss. I'm sure that when the session ends, there will be substantial value addition for the audience in the area of inbound and outbound investment. So best wishes to both of you. Thank you.
Thank you, sir.
Thank you so much, Chitraya sir, for the initiatives that you have shared with the that are happening at the committee, as well as for the benefit of the members, this wonderful Know Your Law series. And every time there is innovative topic, and the speakers are really doing a great job, and members at large are taking the benefit of it. So thanks to the initiatives of the committee, and thank you for joining us with this address. It's indeed a great pleasure to introduce our faculties for the day. CA Amar Govawala and CA Priyanki Lia. As sir has mentioned, they have really taken great efforts to compile a booklet as well as the publications, and a pleasure for me to introduce them on this platform. CA Amar Govawala is a fellow member of the ICAI and has qualified in the year 2013. He is having 11 years of experience and also a partner at a leading firm. He is a part of the team working on 2 publications for FEMA. CA Priyanki Lia has a total work experience of more than 5 years and also has exposures in direct taxation, FEMA, statutory compliances, corporate audit, and tax audits. So today, with their experiences and facilitation on the session on the inbound and outbound investment in FEMA, I am sure that the participants will benefit a lot. And without taking much of the time, I hand over the e-platform to CA Amar Goawala and CA Priyanki Lia. Over to you, all yours. Thank you so much.
Thank you very much. Thank you, ma'am, for the introduction. Thank you, Chitle sir, for the introduction. Chitle sir, chairperson of the committee. Amruta ma'am, chairperson of the Pune branch. Other signatories attending the seminar, and my professional colleagues. A very good evening to all of you. Today, I will be speaking on outbound investments. Now, to enhance the scale and scope of business, the Indian entrepreneurs are now venturing overseas to tap into the wider global markets and to enhance the brand value, to reduce the cost of capital, to tap into technology and research and development. Now, to keep up with the same and to keep up with this sense of liberalization, the central government and RBI are taking various steps progressively to reduce the burden of the procedures. They're simplifying the procedures and rationalizing the rules and regulations. In recent years, FEMA has opened up, and earlier there was a lot of when ODI used to be made, there were a lot of government approvals which were required. Now, a lot of overseas direct investments can be made by automatic approval, where the AD bank is in charge of seeing whether the rules and regulations have been complied with, and also the management and the statutory auditor in some cases. With this regard, we have seen a major development being made. In 2022, the overseas direct investment rules and regulations have been notified. The rules have been notified by the central government. The regulations have been notified by the RBI. And RBI has also issued directions to the AD bank regarding the procedures and rules and regulations which it has to follow. So for us professionals, it becomes a little easy to understand this ODI because it has the latest amendments. Earlier it was notified by notification in 2004 and 2016, and there was various notifications and circulars which we had to refer. But however, now if we refer these rules, regulations, and directions of 2022, we will be able to understand the ODI. In recent years, we've also seen a lot of our clients venturing overseas for investments. And this has enabled us to buckle up and research into the rules and regulation and read the rules and regulations. Now, for us chartered accountants in practice, even if we are not providing consultancy in FEMA, however, if we are doing an audit of an entity, of an Indian entity, which wishes to make an overseas direct investment, this Indian entity will not be able to make the ODI unless he receives a certificate from the chartered accountant regarding the same. So, as a statutory holder of a company who wishes to make an overseas direct investment, we may have to provide a certificate that all the rules and regulations with respect to ODI have been fulfilled by the company. So it has become a critical part these days, and a lot of businessmen are venturing overseas. Now let's look into the latest definitions which the latest rules and regulations have come up with, and the major changes which they have come up with. Earlier, they used to refer to joint venture and wholly owned subsidiary when they used to state for an entity. Now it has been replaced with foreign entity. A foreign entity means any entity formed or registered or incorporated outside India. Hence, it includes LLPs too. However, if you see, it is an or, so registration is not compulsory. Any entity formed or registered. So even if LLP is formed, not registered, it can still become part of a foreign entity. Indian entity definition was always there. It includes companies, body corporates, LLPs, and even partnership firms, which are registered under the Indian Partnership Act. Now, earlier, an Indian entity which was not engaged in financial service activity in India could not make ODI in a foreign entity engaged in financial service activity. Only an Indian entity engaged in financial service activity in India could make an ODI in a financial entity, can make an ODI in a foreign entity engaged in financial service activity. However, now an Indian entity not engaged in financial service activity can make this ODI. They have also brought in the definition of financial service activity. They have defined it. Any activity which, if carried out in India, requires registration or which requires regulation by a financial service regulator. In India, it is the RBI. The definition of control has gone to change. Control means the right to appoint the majority directors or to control the management by virtue of the policies and the directors. However, with respect to the shareholding, in normal parlance and as per Companies Act, normally control, we say 50, if a company holds 51% of the another company, we say it ensures control. But over here, in the control definition in ODI, they have stated if an entity holds 10% or more voting rights in another entity, it exercises control. Now, why this become important, we'll see in another definition. So next definition, for the subsidiary or step-down subsidiary of a foreign entity means an entity in which the foreign entity has control. So control over there, they have stated 10% or more. So if a foreign entity has 10% or more control in an Indian entity, this Indian entity becomes a subsidiary of a foreign entity. Why again it is crucial, if you link to why again it is crucial, is when making an ODI, there is a restriction. A foreign entity, actually not making ODI, any foreign entity cannot invest in India through more than 2 layers of subsidiaries. So now this 10% criteria becomes very crucial, because a foreign entity which holds 10% in an Indian company, the Indian company straight away becomes a subsidiary. So now we have to see whether it is not holding more than 2 layers. We don't have to see the 51% criteria, we have to see the 10% criteria. The net worth definition has gone to change. Earlier, net worth was defined as only has paid up capital and free reserves. Now, they have given it the same meaning as the Section 2, Clause 57 of the Companies Act 2013. We all know the net worth as per the Companies Act includes security premium account. However, it does not include reserves created out of revaluation of assets, right back of depreciation, and amalgamation. So, you can include your securities premium account in the calculation of net worth. Now, why is it important? While making an ODI, there is a condition that you cannot make an overseas direct investment more than 400% of the Indian entity's net worth. So if securities premium is included in the work in the calculation of net worth, it increases the scope or increases the amount which can be remitted. Also, they have given you can calculate the net worth for LLPs and partnership firms also. It will be the same as the capital contribution of the partners and the undistributed profits of the partners. The major three modes by which financial commitments can be made is equity share capital, investment in debt instruments or loans, or any financial commitment by way of guarantee. First, first let us talk about the basics of ODI, and then we will go into the specifics of the equity share capital, the debt instruments, and the guarantees. So now regarding the quantum of investments, as I earlier said, an Indian entity can only make an overseas direct investment up to 400% of the net worth as per the latest audited financial statements, not exceeding 18 months. Now, when we were doing these ODI assignments, there were some questions which came to our mind. Now, a company can prepare its financial statements in Ind AS, whereas some companies may be preparing their financial statements in accounting standards. Now, we all know redeemable preference shares, as per accounting standard, it is a preference share capital, and it will be included in the net worth. It will be included in the shareholders' funds. In the balance sheet, it will be in the net worth, which we say as a net worth. But in an Ind AS balance sheet, these redeemable preference shares will be treated as a borrowings, as a liability, and it will not be treated as a capital. So it will not be there in the shareholders' funds. Now, when you're making an ODI, how to consider the net worth if you're taking Ind AS financials? The answer is you have to go as per the audited financial statement. If the audited financial statement have been prepared in Ind AS, so whatever the net worth they have shown disclosed in the balance sheet, that is the net worth. That means the preferential capital will not be included with respect to the Ind AS balance sheet, and a preferential capital will be included for the accounting standard balance sheet. Second question which came to our mind was, there was a mention on latest audited financial statements. So which financial statement should we refer by making an ODI? Now, suppose if a company wishes to make an ODI in May 2024, as we all know, right now, the financial year 22-23, the due date for filing the balance sheet in ROC is September 2024. So that means a lot of companies might not have the balance sheet ready yet. So in that case, you can consider the net worth as per the balance sheet of 22-23. However, if the company has prepared its balance sheet by May 2024 and it is audited and it is signed, then now this 22-23 balance sheet is valid for considering the net worth only up to 30th September 2024. Because from 1st October, you have to consider the 2023-24 balance sheet for calculation of net worth. If the company by chance has not prepared its financial statements, or if it asks for an extension of its AGM, you may not be able to do the ODI, because the latest audited financial statement will be required, and you have to see that the ODI is not exceeding 400% of the net worth. One more question which came to our mind was, this company, as we said, is making an ODI in May 2024 as per the net worth calculated by the financial statements of 22-23. Now, in financial 22-23, it had a good positive net worth, and it made in May 2024, it made the overseas investment up to 400% of the net worth of as per March 23. Now, in 2023-24, the company's incurred a loss and the net worth has reduced. Now, if I again try to recalculate it as on March 2024, what will happen is my OD amount which I have done might be more than the 400% of net worth as of March 2024. So what should be done? As per me, there's nothing which has to be done. This condition is only to be seen when you're making the overseas direct investment. So when you made an overseas direct investment, that time the valid balance sheet was 22-23. That time your investment was within the 400% limit. So you are okay. Afterwards, obviously, company can incur losses. That doesn't mean you have to repatriate the money back. So that is okay. Now, another important point is, if the foreign commitment in a financial year is exceeding $1 billion, approval of RBI is mandatory. even though the financial commitment of the Indian entity is within the eligible limit and under the automatic rule. This limit of 400%, however, does not apply if investment is made out of balances held in exchange earners foreign currency account of the Indian party or the funds raised through American depository receipts or global depository receipts. An Indian entity who is doing a lot of export sales may have exchange earners foreign currency account open to save on his foreign exchange. So they can make they can make a remittance from there, and 400% limit is not applicable for this. Now, one major change utilizing the net worth of the subsidiary or holding company by the Indian entity has been discontinued therefore. Earlier it was allowed, now it has been discontinued. That means you have to see that entity's net worth itself. You cannot use the subsidiary or holding company's net worth. We look into the various forms which have to be submitted while making an overseas direct investment. Earlier, the form name was ODI. Now it is Form FC. So this Form FC is to be duly filed and it is to be signed and certified by the management. Now, for the first time when you're making this ODI, when you're filing this Form FC, you will be given a UIN of the foreign entity will be generated. Now, this UIN, the Indian entity will have to code for making any foreign overseas remittance to this entity. So this UIN will be valid for the Indian entity and that foreign entity will be valid. So then one important thing is a statutory auditor certificate. We'll discuss this more in detail later on. Then a board resolution of the Indian entity is required, whereby to make this, the management will define where they are, in which sector are they making this ODI remittance. But if you are making an investment in equity shares, the valuation report is required because you have to take care of the pricing guidelines, which we shall discuss in detail later on. Then there should always be an underlying document. If we are investing in equity share capital, there has to be a share purchase agreement. If we are investing in loan, if we are giving a loan, there has to be a loan agreement. If we are giving any guarantee, there has to be a guarantee. So there has to be an underlying document. AD banks now also require an undertaking to be given by the Indian company that all the FEMA compliances have been complied with. Then there is FATF, Financial Action Task Force compliances, which have to be other, which we shall discuss more in detail later. And Form A2 to ask the bank to remit the money. So how is the Form FC structured? Now the Form FC Part 1 is this Part 1 is the ODI form for making the financial commitment abroad. Now this Part 1 has various sections. So Section A, basically you have to give the details of the Indian party or the resident individuals. And then Section B, you have to give details of the foreign entity, with respect to the name of the entity, the address, the activity code in which the foreign entity is engaged in, the amount of financial commitment being made, and the sum total of financial commitment made in the foreign entity, including the proposed remittance. You also have to give the proposed updated shareholding of the foreign entity after this ODI. If the overseas, if the subsidiary in which you're making ODI has a step-down subsidiary, then you have to give details of the same. In Section C, you have to give the nature of investment being made, whether you are making an ODI by way of loan or by way of equity share capital, by way of guarantees, by creation of charge, pledge, you have to mention that. And Section D are the various declarations. You have to give declaration that the pricing guidelines have been followed with. If NOC requirements are there, then whether the NOC has been obtained, whether the earlier compliances have been done, whether the share certificates of the earlier ODI has been submitted, whether there's no delay in any previous compliances. And if he's a resident individual, the ODI can be done only the limit of the liberalized remittance scheme, which is a 250,000 USD per year limit per financial year, which is a limit in India. If gift, whether the regulations regarding the same have been followed. So these all declarations have to be given by the Indian entity in Section D. Section E is where the statutory auditor, the chartered accountant, who is a statutory auditor, certifies that all the rules and regulations with respect to the ODI have been followed. Now, this was Form FC Part 1. Form FC Part 2 is an annual performance report. Now, this is not to be submitted at the time of making an ODI. This is an annual performance report which we have to submit, and currently the due date is 31st December of the financial year. We'll talk more into it later. And the Form FC Part 3, this is the reporting if you have made a sale or transfer of those shares of the foreign entity, or if there's a disinvestment. So then you have to give reporting in Form FC Part 3. Now this Form FC, it has to be manually submitted to the bank along with all the documents. So if you go into the annual performance report, which has to be filed, currently, as I mentioned, the due date is 31st December of the end of the year. Now, APR is basically contains, we have to mention details of the share capital of the foreign entity, the net worth of the foreign entity, and profit and loss of the foreign entity. Now, this APR is required to be signed by the management and certified by the statutory auditor. One more important requirement is we require the audited accounts of the foreign entity. It is mandatory if the Indian entity has a control over it. For example, if an Indian entity has a control over the foreign entity, then the foreign entity will have to provide its audited accounts, even if audit is not applicable in that country. And now control, we have seen the definition is 10% or more. So if an Indian entity exercises 10% or more shareholding in a foreign entity, that foreign entity will have to get its account audited and provide to the Indian entity. And on the basis of these audited accounts only, the management will fill in the APR and the statutory auditor will certify the same. Also, a board resolution will be required wherein the Indian company will accept the books and the financial statements of the foreign entity. So whenever you're submitting the form APR, it will be prepared by the management, signed by the statutory auditor, then the financial statements of the audited financial statement of the foreign entity will be attached to it. The board resolution will be attached to it, and that will be manually again submitted to the AD bank. And the AD bank will give an acknowledgement, which this has to be saved. Whenever we are making an ODI, we have to check that the previous APR has been filed or not. Otherwise, we cannot make an ODI. One more critical condition is, once an ODI has been done, the share certificate of this ODI has to be submitted to the bank within 6 months from the date of remittance of the funds. If not done, you cannot make another ODI. So when you're making an ODI, you have to see if an ODI is done previously, whether the share certificate has been obtained for the same and whether submitted to the bank. And in case where the share certificate has not been submitted to the bank within 6 months, then the money will have to be repatriated back within the period of 6 months. So this is a big, it is an important point. If you're making investment in equity share capital, you have to ensure the share certificate received and submitted to the bank. Then there's a form FLA, which is to be filed within the due date, and the due date is 15th of July. It basically has details of foreign assets and foreign liabilities. Statutory auditor certificate. I've already explained how critical this statutory auditor document is. To understand more deeply, an AD bank is going to remit money overseas on the basis of a certificate of a statutory auditor. Statutory auditor is certifying that all the rules and regulations as per the ODI has been complied by the Indian entity, on the basis of which the AD bank is making the remittance outside India. So it becomes very critical. Here, RBI is involved, FEMA is involved, so we know how critical this can go. Now, first, let's look into what all aspects we have to certify and how we should protect ourselves and how we should document it. We should look into it. In ODI, there are certain areas which are restricted and prohibited. So you should ensure that the overseas direct investment is not being made in these restricted or prohibition areas. Again, the total financial commitment along with the proposed financial commitment should not exceed 400% of the Indian company's net worth. That should be complied with if you're making an investment in, if you're making a financial commitment. Now, if Indian entity is making a financial commitment by way of equity shares, then the pricing valuation norm should be complied with. If the ODI has been done in a financial service activity, then the rules and regulations regarding the same have to be complied with. Again, as I mentioned earlier also, the critical point is the earlier compliances should have been done. So, and the statutory auditor should also has to check and certify that the previous regulations have been complied with. Whether APR has been filed, whether the share certificate of the previous ODI has been submitted to the bank. So these all, if there's a delay, the delay should have been regularized. So this auditor has to certify. If the remittance is in case of personal guarantee given by director or promoter of one of the company, then all the regulation regarding the guarantee and committee, the guarantees have been complied with by the company. Now, this how we should document it. See, with regard to the statutory auditor certificate, we should follow our auditing standards, and most important is the documentation. We should obtain the underlying document of the ODI. If you're investing in equity shares, we should have the share transfer agreement with us. If we are investing, if the entity is investing in, if he's providing a loan, we should have the loan document. If the entity is providing a guarantee, the guarantee document should be there. So the underlying document should be clear and it should be signed and it should be available with the auditor. Then auditor has to check the calculation of the total financial commitment done as on date by the Indian entity in various foreign entities. See, this limit of 400% is with respect to all investment in all foreign entities. We have a client wherein he has made a numerous investment in numerous foreign entities and at various dates. So we have to check, we have to calculate the total foreign commitment, the total financial commitment made till date. Now, sometimes the financial commitment is done in by way of guarantees. So it may not come in your books of accounts. It may not come in your ledger. So it will be difficult to trace if a financial commitment has been done. So it's very important to keep if you're a statutory auditor of an Indian entity which is constantly making investment in foreign entities, you should keep a track of each and every ODI which has been done, and it should be properly, and you should properly calculate the total financial commitment which has been done as on date, and you add the current proposed remittance. Consider the guarantees also, consider loans also, and you have to consider equity capital also. Then again, if you're making an investment in equity shares, the valuation report and pricing guidelines have to be complied with. Then we have to document which sector this ODI is being done. We have to ask for the MOA, AOA of the foreign entity and the board decision of the entity, where the foreign entity is engaged in which sector. So we have to check whether it is under the permissible sectors. Again, the previous ODI compliances, we should have the acknowledgement of the same. We should have the acknowledgement of the earlier shareholder certificate, which have been submitted to the bank. Not only the shareholder, not only the share certificates, but acknowledgement on in our document, and we should also have the document that all the previous APRs, FLS, they have been filed. Again, the most important part of an auditing standard, we have to obtain a management representation letter and also an audit engagement letter. Then the auditor should give appropriate disclaimers in the certificate. And the auditor may also give notes in the certificate if he wishes to bring out certain importance. Like we give emphasis on matter paragraph in our audit report, you can give notes in the certificate if you want to highlight some points. Maybe you don't want to qualify, but you want to highlight some point. And document this calculation of 400% of the net worth. Very important. Now, let's see regarding valuation. As we discussed earlier, an Indian company cannot remit if you're making an equity share, if you're making an overseas investment in equity share capital, we cannot remit more than the fair value at arm's length of the investment company. That means we have to have the valuation report of the foreign entity, and the investment cannot be more than the fair value which has been derived with. Now, we have to also take into account what any regulations of the income tax may come into account. For example, Rule 11UA of as per Section 56(2)(10), if an Indian entity receives if it purchases of equity shares at less than the fair value as per the Rule 11UA, then the differential amount will be taxed in income from other sources. Now we have to see there is a difference over here. In FEMA, the valuation is as per the fair value method, as per the discounting factor method. And in income tax, it is as per the Rule 11UA. Rule 11UA is basically the net worth, where you substitute the market value of the fair value of your fair value or market value of your immovable properties or your investments. So the valuation as per 11UA will be different, and valuation as per fair market value will be different. So we should ensure that the valuation should be higher or equal to 11UA and less than or equal to the fair value as per a DCF method. So these both should be ensured. When you're providing consultancy to the client, we should ensure both these criteria have been complied with. Now, if an investment in a foreign entity exceeds 5 million USD, then you require the valuation report from a merchant banker. Now, this is only with respect to one single foreign entity. Suppose an Indian entity has investment in two foreign entities. In one foreign entity, the investment is exceeding 5 million USD. So for that foreign entity, the valuation report has to be done from the merchant banker. But for the other foreign entity, he can get it done from a chartered accountant in practice in India. So this valuation report is important because the DCF is done as per the DCF method, and we cannot remit more than the fair value method. Now, regarding the Financial Action Task Force. Now, this is a global money laundering and terrorist financing watchdog. It sets international standards that aim to prevent these illegal activities and harm the cause of the society. An Indian entity cannot make an ODI in an overseas entity which is located in a country which is identified by the FATF as non-cooperative countries or territory, non-cooperative countries and territories. Now, why this so? Of course, now FATF, they have identified certain countries where there is not much regulation on the funds, or where maybe they think that the country is financing terrorism. So we are an Indian entity is prohibited from making an investment in that entity because the funds can be used for uh, purposes like terrorism or not for the desired purpose. Now they have this website, so you have to access the website which I've mentioned over here, and as a matter of precaution, you have to download this list because this list keeps on changing. So as the time during the time of making the ODI, you should ensure the country in which you are making the remittance or which country in which you're making the financial commitment, it is not uh, covered or it is not restricted by the FATF at that time. Afterward, it is restricted. That is a different thing. That's not a problem. But that the document should be done. Now, there is certain if a Indian entity has a bank account which is a non-performing asset or is a willful defaulter in India or is under any investigation, he will require an NOC from these relevant agencies within 60 days from the application. Now, why this so? Now, this Indian entity, he is not repaying back his loan in India. It has a account which is a non-performing asset, is a willful defaulter, and he now wants to make a overseas investment. So he does not have funds to repay his loan, but he wants to make an investment. So of course it will not be permitted unless an NOC is received from the relevant agencies within 60 days from the application. Further things to be kept in mind while making an ODI are all transactions relating to a particular joint venture or wholly owned subsidiary should be routed through only one branch of an AD bank to be designated by the Indian party. And it can be done, but then you require the approval of the RBI, you require NOC from the earlier bank. So it is better you do it from only one AD bank. Otherwise, you have to go through a lot of rules and regulations. Now, foreign currency accounts cannot be opened abroad for making ODI. It has to go from India. It cannot go from the directly foreign currency accounts abroad. One important aspect when making an ODI is an Indian entity should realize and repatriate back to India all dues receivable from the foreign entity, including the sale purchase on account of sale of shares or disinvestment within 90 days from the date on which the share transfer has been done. Delays in reporting. Now, we do not want to get into that actually, because you don't want to get into the wrong side of FEMA, you don't want to get into the wrong side of RBI. However, if there is a delay, this is earlier this was not there. Now, right now they have got the concept of penalties. So if there's a delay and up to within 3 years, if you submit the reports and you submit the forms along with the penalty, it is okay. So you can do it. Now, there are two types of penalties. One, which involves a transaction reporting. Transaction reporting basically where funds are being remitted outward or inward. For example, ODI. So if there's a delay in submission of an ODI, the penalty is rupees 7,500 plus 0.025% of the amount involved into the number of years delay. And if there's a delay with regard to submissions of periodical reporting, like your APR or FLA, it is rupees 7,500 per return. So if there's a delay within 3 years, we can pay the penalty and submit the forms. Now, if the delay exceeds more than 3 years, then penal action can be started as per the FEMA Act, and the Indian entity will have to apply for compounding. One important thing is no further ODI will be allowed to the Indian resident up to the time the delay in reporting is regularized. So it's very important. We as it is do not want to go into the wrong side of FEMA and RBI. And if an Indian entity fails as non-compliant, the non-compliance mark comes on him, and he will not be able to make another remittance till the time of the delay is regularized. Now, what happens basically in any Indian entity if he is making an overseas investment? So suppose if he set up a subsidiary over there, he has to constantly fund that company. So if there's a delay in reporting, he may not be able to send further funds, and which may block maybe the working capital, or maybe block the capital expenditure which might be taking place in the foreign country. Now, there are certain general permissions which have been given in the ODI where the ODI rules and regulation will not apply. If you are making a purchase or acquisition out of funds held in resident foreign currency accounts. This is basically the savings account in foreign currency for NRIs who have returned to India and they hold these funds in foreign currency account. Or if a remittance is made out of foreign currency reserve held outside India by a person who is employed in India, irrespective of the length, or for a specific job or assignment, duration of which does not exceed 3 years. A person resident in India may hold, own, or transfer foreign security outside India if such security was acquired by him when he was resident outside India or inherited from a person outside India. Now, the restrictions which I was speaking about earlier, we cannot make an Indian entity cannot make a financial commitment overseas in the real estate in the trading of real estate sector. In real estate sector, if it is making for development of townships, for development of residential building, development of commercial buildings, roads, bridges, that is another automatic rule. But you cannot make an investment for trading in real estate, buying and selling of property or trading in TDR. That is not allowed. Development work is allowed. Obviously, gambling in any form, you cannot make any remittance for gambling, or you cannot make any remittance for to a foreign entity which is dealing with financial products linked to the Indian rupee without specific approval of RBI. As I said earlier, now there's a condition which they have put in this rules and regulations. And ODI in a foreign entity that has invested or invest into India at the time of making ODI at any time after directly or indirectly, resulting in a structure with more than 2 layers of subsidiaries. Suppose if we have made an ODI in a foreign entity, now the foreign entity should not invest back in India with more than 2 layers of subsidiary. This is not prohibited. And now, if you're making an ODI in a startup, you have to ensure that the company has done it from his own internal accruals. If a resident individual is doing it, it has to be from his own funds. Of ODI in any foreign country, like example Pakistan or any other jurisdiction which the central government may notify, then you require the approval of the central government. However, these restrictions which I've mentioned do not apply to banking company, NBFC, insurance company, and government companies. Now we go into the detail in basic different types of the mode of investment which we can make. Investment in equity share capital. Investment in equity share capital can be made by way of subscription as a part of MOA, like when the to incorporate a company, or you can purchase equity shares listed or unlisted from another company. Acquisition can be done through a bidding or tender procedure. A resident Indian who has equity shares of a foreign entity, he may receive rights issue or bonus issue. So that can be acquired. Then there may be an Indian entity may have an amount receivable from a foreign entity, which can be capitalized in the form of a capital. So that can be done. Swap of securities allowed. However, both legs of transaction should comply with the FEMA provisions. Then acquisition of acquisition and equity share capital can be done by way of merger, demerger, amalgamation, or any other scheme of arrangement. But however, it should be as per the applicable laws of the host country. Now, as I said, a person resident in India who has acquired or continues to hold shares in a foreign entity, which is as per the rules and regulations, he may receive rights issue or bonus issue. Now, acquisition by way of rights issue, that will have to be reported in the form FC, and it will form part of the commitment. However, if he has received bonus shares, he is not making any payment if he received bonus shares. So it will not be treated as a financial commitment, and it will not require further reporting. Rights issue will require reporting, but bonus share will not require reporting. Now, if you're renouncing this rights issue in favor of a person who is resident in India, then no reporting. Now, basically, we go to debt, we check debt instruments. An Indian entity shall not lend directly to its overseas step-down subsidiary. It cannot go and directly lend to its overseas step-down subsidiary. A resident individual shall not make any financial commitment by way of debt. It can be done by an Indian entity, but not a resident individual. Okay, as I earlier said, a bona fide document of the loan transaction is a must. An Indian entity may lend in or invest in debt securities issued by a foreign entity subject to the interest rate. The interest rate should be as per the arm's length price. Even in as per the Companies Act, as per the Section 186, we cannot give interest-free loans. So in ODI, with regard to FEMA also, if a loan is being advanced or if any investment in debt securities, the rate of interest should be as per arm's length price. Investment in debt instruments can be made in the following forms: government bonds, corporate bonds, any tranches of securitization, borrowings by firm through loans, depositories. So that can be done. With respect to fund guarantees, now an Indian entity can give corporate or performance guarantees to or on behalf of the foreign entity or any of its step down subsidiary in which the Indian entity has control through the foreign entity. That means an Indian entity cannot give a guarantee to any foreign entity. It should be at least a step down subsidiary or any entity which it acquired control. Now, whenever guarantee is given, it cannot be open-ended, but it has to be closed. If the performance is done, the guarantee ends. The guarantee limit closes. It cannot be an open-ended guarantee. If there's a performance guarantee, once the contract is complete, so it should be treated that the guarantee is closed, another validity period is closed. Now, if an Indian entity has given a performance guarantee and now funds need to be remitted, the guarantee is invoked and now funds need to be remitted. So now no again prior approval of RBI is needed for the same. Now again, if the guarantee is invoked and funds have to be remitted to the foreign entity, the financial commitment will cease to be part of a non-fund based debt commitment and will go as a financial commitment by way of debt. It will not be added again. Your guarantee commitment will reduce and your loan commitment financial commitment will increase. And you have to report it in your form FC. Rollover of guarantee shall not be treated as a fresh financial commitment. However, reporting will be done in form FC. Now, in our experience, these are the two cases which we have faced, also, and which is also be allowed by the FEMA. An Indian group company of an Indian entity may extend a guarantee in accordance with the rules and regulations if such group company is eligible to make ODI as per the rules and regulations. And it will be counted toward the utilization of the financial commitment of such group company and will be reported by the group company concerned. That means a group company of an Indian company can make a guarantee for that Indian entity. Now, there are a lot of cases where a foreign entity in which an Indian entity has made an overseas investment. Now, this foreign entity wishes to take a loan in a foreign country from a foreign bank. The foreign bank may require the resident Indian promoter of the Indian entity to provide a guarantee. He can do so, but it will be counted as a financial commitment limit of the Indian entity and accordingly will be reported by the Indian entity. It will not be regarded as a ODI done by the promoter. It will be treated as an ODI done by the Indian entity. We had this case, A Private Limited, along with another company, B Private Limited, has made ODI in a company, USA, XINC. Now, this XINC wishes to take a loan of rupees 100 crore in USA from a bank in USA. The Indian entities, who are the promoters, who are the shareholders, are required to give guarantee individually for the loan. So now, how much will be the financial commitment will be considered for the Indian entity? Now, two Indian entities are giving a guarantee for the loan taken by a foreign entity of rupees 100 crore in the foreign country. Answer is the financial commitment with respect to each Indian entity will be considered rupees 100 crore because any one of the Indian entity will be maybe liable to pay, maybe asked to pay the maybe asked to pay the guarantee amount. So you have to for both the companies that financial commitment limit will be used of rupees 100 crores. It will not be rupees 50-50. It will be rupees 100 crore to each. It will be as a financial commitment has been given individually by each company of 100 crores. ODI under financial service activity. An Indian entity engaged in financial service activity in India may make an ODI in a foreign entity which is directly or indirectly engaged in financial service activity subject to the following conditions. The Indian entity has posted net profits during the preceding 3 financial years. The Indian entity is registered with or regulated by the financial service regulator in India. The Indian entities obtain approval as may be required from the regulators of such financial service activity, both in India and the host country or host jurisdiction, as the case may be for engaging in such financial sector. Now, as I earlier said, an Indian entity not engaged in financial service activity in India can also make an ODI in a foreign entity which is directly or indirectly engaged in financial service activity, except banking or insurance. Now, the conditions are that the Indian entity has posted net profits during the preceding 3 financial years. Now, for both these cases, if the criteria of net profits is not being met because of the impact of COVID-19 during the period FY 2021 and 21-22, then the financial results of such period may be excluded for considering the profitability period of 3 years. We have to include the other financial years, before financial years we have to include. Now, ODI can also be done by a resident individual. Now, however, it can be only made under the liberalized remittance scheme of FEMA, of RBI, which is up to rupees 250,000 USD per year. And resident individual can acquire equity shares through rights or bonus issues. They can acquire without any limit any foreign securities by way of gift or from inheritance from a person resident in India or person resident outside India who is a relative and who has acquired foreign securities as per the rules and regulations. Now, this will not form part of LRS. If an resident individual has acquired shares of a foreign company by way of gift or from inheritance from a relative who is a person resident in India or resident outside India, it will not form part of the 250,000 limit. It can acquire that apart from that limit. Any resident individual can receive the sweat equity shares. Sometimes, if a resident individual is holding a post, handling a management post in a company, you have a minimum qualification shares which you can subscribe to. So, acquisition of minimum qualification shares issued for holding a management post in a foreign entity is allowed. He may receive shares by way of ESOPs or the employee benefit schemes of the foreign entity. Of there's any dues which are realizable from the company, they may capitalize into equity shares, and that is permitted and is not required prior approval of RBI or central government. Swap of securities is allowed on account of a merger, demerger, amalgamation. Now, with respect to ODI, in case of inheritance, acquisition of sweat equity shares, acquisition of minimum qualification shares for holding a management post, acquisition of shares under ESOP, may be made in a foreign entity, whether or not such foreign entity is engaged in financial service activity or has a subsidiary or step-down subsidiary, whether a resident individual has control. Another concept which the 2022 rules and regulations have got is acquisition can be made by way of deferred payment. So if a person resident in India wishes to acquire shares of a foreign company through purchase or by subscribing to a share issue, he can make the payment by way of deferred. He can do it by making deferred payments, but it has to be for a definite period of time. It cannot be indefinite. It has to be for a definite period of time from the date of the arrangement, however, subject to the following rules and regulations. Now, the total amount of consideration should be considered for the 400% net worth. The deferred part of the consideration shall be treated as a non-fund based commitment. Hence, you have to consider the payment which is made will be treated as the fund-based commitment, and the deferred amount will be treated as a non-fund-based commitment. Both these should be within the 400% limit. The one condition is full consideration paid should be in compliance with the applicable pricing guidelines. So when you see pricing guidelines have to be followed, and you have to see it according to the full consideration. Foreign securities equivalent to the amount of consideration should be transferred or received to the buyer by the seller. So the Indian entity should or a person resident in India should have received these shares. The foreign security should be received to him from the seller. Now, with respect to transfer and liquidation, a person resident in India may transfer investment in equity capital if it is in compliance with the pricing guidelines, documentation, and reporting requirements of the rules and regulations. Now, if an Indian person is selling the shares of a foreign entity, then he cannot sell the shares at less than the fair value of the shares. He will have to file the FCTRS, which will be required to be filed. So he will not be able to sell the shares at less than the fair value of the foreign company. While making investment, you cannot make investment more than the fair value of the share for fair value equity shares of the foreign company. And while selling, you cannot. And if you're selling to a person resident outside India, you cannot receive money less than the fair value of the shares of the foreign entity. And form FCTRs will have to be filed. If the transfers are on account of merger, amalgamation, demerger, liquidation, the approval of the competent authority of India or the host country is required. Maybe NCLT, ROC, they're required because a merger demarcation is taking place. Again, as mentioned earlier, a person resident in India who has made an investment overseas, now he wishes to sell his shares, he should repatriate, he should realize and repatriate to India the sale proceeds within 90 days of such transfer or disinvestment. Now, after the foreign entity is liquidated or and the amount has been realized, he has to file the form ODI. He has to file the form FC, section 3. It should be within 30 days of receipt of disinvestment proceeds. So disinvestment, the amount should be realized within 9 months, and the form FC, the amount should be received within 90 days of such transfer or disinvestment, and the form FC should be filed within 30 days of such receipt of disinvestment proceeds. I will conclude my chapter. My conclusion is that we have to study the ODI rules, regulation, directives 2022 thoroughly before making or advising a client regarding making an ODI. For providing statutory audit certificate for an ODI, documentation and auditing standards should be followed, should be thoroughly followed. The consultants should ensure that all requisite compliances with respect to the filing and submission of form is done by the client without any delay. Thank you. Sorry, ma'am, the battery has gone. Hello. Yes. Okay. Okay. Just give me a moment. लेकिन तुम्हारा आवाज नहीं आ रहा है। नहीं आ रहा है, नहीं आ रहा है। तुम ईयरफोन्स पहले इसके लिए आ रहा है, तुम ईयरफोन निकाल के करो तो लाउड स्पीकर पे।
Hello, am I audible? Hello,
Yes, now you're audible.
hello, am I audible?
Yes, now you're audible.
Okay, yes. I'll share my screen. Yes, my screen is visible to everyone. Yeah. Hello, everyone. The chairperson of the Pune branch, Amrita ma'am, the chairman of the chairman of the committee, Chittale sir, and other dignitaries and my fellow members. Very good evening, everyone. Today we will discuss the inbound investment under FEMA. Am I audible, right? Audible. No? Yeah. FEMA has brought the Indian economy into the arena of the globalization. The FEMA has introduced the policy that is liberalization, privatization, and globalization, which made the ease of the foreign trade and investments, and which leads to the higher economic growth. So the Indian business can get the foreign investment, foreign capital throughout the globe. That is because of the FEMA has made the liberalizers policy. So there is mainly two types of investment, that there is inbound investment or there can be outbound investments. So inbound investment means the person resident outside India invest in the Indian business. There is inward of the investments. So it is inbound investment, and outbound investment means the person resident in India invest in the business country outside India. We will discussing today the inbound investment in detail. There are mainly two types of the investments in which the foreign investor can invest. Either it is debt instrument or it is non-debt instrument, that is equity instruments. In debt instrument, the foreign investor can invest, can take the external commercial borrowings, that is borrowings from the foreign bank or foreign financial institutions. Yes, it is allowed, but there is a specified rate or the cap is provided under the FEMA, which have to be complied with. And another way is trade credit, that is suppliers credit. The Indian entity can avail the suppliers credit from the foreign entity. So why the Indian business brought the external commercial borrowing or trade credit from the outside India? Because of it is rate lower than the Indian bank bank interest rate available in the Indian banks. So rate is cheaper. But yes, obviously there is exchange rate risk is there by taking the rate from the outside India. So if we can mitigate that risk by hedging our funds. So yes, we can take the ECB or trade credits. Second part is the non-debt instrument, that is equity instrument. So foreign investor can invest in equity instrument in various ways. So there are various types of the investment in equity instrument. First is the foreign direct investment. Foreign investor can invest directly in the capital of the company, either in the private limited company or in the listed company also. But in case of listed company, the investment stake should be more than 10%. That will be considered as foreign direct investment. Foreign portfolio investment means the foreign investor invest in the stock exchange market, means invest in the listed company and the stake is less than 10%, then it shall be considered as the foreign portfolio investment. Third type is the investment by NRI or OCI on repatriation basis, in which the NRI or OCI invest in the stock exchange from the NRE account or FCN account only, and they can be repatriated outside India. Fourth part is the investment by NRI or OCI on non-repatriation basis, where the NRI or OCI cannot repatriate the amount. It can be remitted only in the NRO account only. So, fifth part is the investment by the other non-resident. Next is the investment in LLP. Foreign investor can invest in the limited liability partnership, which can be on repatriation basis, or which can also be non-repatriation basis. Then investment by the foreign venture capital. That is the foreign venture capital. Capital investor can invest in specific sector, that is biotechnology, nanotechnology sector, or IT sector of hardware or software business. Then milk, poultry industry. There are specific sectors provided in which the foreign venture capital investor can invest. Then investment by a person resident outside India in investment vehicle. Means the investment vehicle, there are types of investment vehicle, which means the real estate investment fund, infrastructure investment fund, or alternate investment fund, in which the foreign investor can invest. And the last one is the investment in Indian depository receipt. Now we will discuss the types of equity instrument. What are the types of equity instrument? Equity instrument can be of three types. It can be either equity shares, or compulsory convertible preference shares, or compulsory convertible debentures. That means that there cannot be non-convertible preference shares or redeemable debentures. If non-convertible preference shares or redeemable debentures, that it cannot be the part of the equity, so it is excluded from the equity instrument, and it does not qualify as FDI if it is non-convertible. So there should be compulsory convertible preference shares and compulsory convertible debentures. Now, the foreign direct investment and the foreign portfolio investment. What is the difference between this? So FDI means the investment made by the foreign non-person resident outside India in the equity capital, either in the private company or unlisted company, then it shall be considered as FDI. But if it is make investment in the listed company, then the percentage should be 10% or more, then it shall be considered as FDI. And if the percentage is less than 10%, then the investment shall be considered as FPI, foreign portfolio investment. Now, what is the scheme of FDI? Foreign direct investment scheme. So, who are the eligible entities where the investment can be made? Matlab, foreign investor, in which type of entities the foreign investor can invest? There are only two types, companies and LLPs, in which the foreign investor can invest. Then second is the mode of remittance. Mode of remittance through the banking channel only is allowed, that is from the foreign inward remittance certificate, or either through NRE or FCNR account. Then third is the sectoral cap. There are various sectors in which the government has provided the sectoral cap, means that the beyond that percentage, the non-resident person cannot invest in specified sector. So, like generally many sectors are provided as 100%, but specifically the sectors like biotechnology or the specified sectors where only telecommunication sectors, where there is 49% of the stake is allowed to invest by the foreign investors. So, according to the sector, there are sectoral cap is provided by the RBI. Then the type of instrument for investments. What are the types of instruments? And the valuation norms. What are the valuation norms that is provided by the RBI? That means valuation pricing guidelines should be followed. We will discuss it later. Timelines for the compliance and process in compliance. According to the next, FDI eligible entities and mode of remittance. So as we discussed, eligible entities can be company registered under the Companies Act. Means that company can be either private limited company or listed company or unlisted company. Any company is there, but it should be registered under the Companies Act. And second is the LLP. Under certain circumstances, there is certain conditions are there which needs to be complied. And the mode of remittance is by inward remittance through banking channel only is provided. RBI has provided a certain list of sectors which are totally prohibited to make the investments by the foreign investor. So foreign investor cannot invest if the Indian entity is engaged in these sectors that are lottery business, including government lotteries, then gambling or betting or cheat fund, then trading in transfer of development rights, then the manufacturing of cigars or tobacco substitutes. Then if the Indian company is a Nidhi company, that foreign investor cannot invest. Then the real estate business or construction of farmhouse. Here, the normal real estate construction company in which the foreign investor can invest. Here does not mean the normal construction of company which has the business of construction of residential or commercial business. But here means the trading in real estate property. So government does not want to give the more deviation in the real estate property as it is highly volatile. So only trading in real estate business is prohibited by the foreign investor. Then the sectors which are not open to private sector, that is government has the control, that is the atomic energy, railway operations, etc., which are prohibited by the foreign investor. Now, the FDI has provided the sectoral cap. Means that in various sectors, they have provided the limit by which the foreign investor cannot exceed their investments. So there are, if it is complied with the sectoral cap, is complied with and the other conditions which are specified in the FEMA regulations, which will be complied, then the automatic route will be selected. There are two routes: automatic routes or approval routes. So approval routes came into picture when there is when foreign investor goes beyond the sectoral cap and all the conditions can maybe all the conditions not compliant, then you need to get the approval from the RBI, from the FIFP portal. So there are two routes: approval routes or automatic routes. Now, issue or transfer of shares. There can be inward of foreign currency. So, inward of foreign currency, either foreign investor can invest in the equity share of the company by issuing the fresh capital or by transferring the shares from the resident person to the non-resident persons. So, there are two types from the inward of foreign currency, and one is another part is there is outward of foreign currency where the non-resident person sell his shares in equity investments. Then there is outward of foreign currency. So when we will discuss the pricing guideline, the RBI has provided the pricing guidelines which have to be complied with at the time of issue of the equity instruments. So we have to comply with these pricing guidelines. So when the equity instrument is issued by the company, the company has कोई एक company है, for example, ABC Private Limited, which company has issued the shares to the foreign investor. This is that. So if company issue the fresh capital to the foreign investor or transfer its shares by resident to non-resident, in both the cases, the price of the equity instrument should not be exceed the price worked out with SEBI guideline and or the arm's length price, which is calculated on the internationally accepted pricing methodology. In both whichever is higher. So price should be worked out with the SEBI guidelines, that is discounted cash flow or valuation of equity instrument as per internationally accepted pricing methodology. We will take an example of this case. Suppose ABC Private Limited issued shares to Mr. Z, a non-resident person. Valuation of share shall be equal to or higher than the discounted cash flow price. So when there is inward of foreign currency, the government says the price which they have decided should be the minimum. So your price can be higher than that of that decided by the SEBI guidelines. So the valuation of the shares should be equal to or higher than the price decided by the SEBI guidelines. So price worked out with SEBI guidelines is 200. So you can issue the shares at 200 or above 200. But when you issue the shares above 200 price, say for example, you have issued the shares for 210. So so you have to kept in mind the Income Tax Act also, Section 56(2)(7)(b), when there is issue of shares above the fair price, then it shall be considered as the income under Section 56(2)(7)(b). Now, instead of issuing the fresh issue to Mr. Z, Mr. Z has purchased the shares from the resident person. So the valuation of shares in this case shall be equal to or higher than the discounted cash flow price. So if the SEBI guidelines price, that is 200 SEBI price work out with the SEBI guidelines is 200, then you have to issue the shares beyond the 200 rupees. But yes, in that case, Income Tax Act will say 56(2)(10), where an individual receives the shares on and above its fair market price. So that shall be which will be part of their income. Now, valuation norms, pricing guidelines in case of equity instrument transfer by non-resident person to resident person. So there is outward of the foreign currency. So they are withdrawing their investments. In that case, SEBI said that equity instrument जो प्राइस सेबी ने डिसाइड किया है या सेबी के गाइडलाइंस से जो डिसाइड हुआ है उससे इंक्रीज नहीं होना चाहिए. That shall be the maximum price, should not exceed the SEBI guideline price or valuation of equity instrument as per internationally accepted pricing methodology. So that shall be the maximum price. So we have to catch that when there is inward of foreign currency, inward of capital, then foreign capital, then there is the price decided by the SEBI guidelines shall be the minimum price. And when there is outward of the foreign capital, they are withdrawing the capital, selling the shares to the resident person, then the price decided by the SEBI guidelines should be the maximum price. You can issue the shares below that price. So, for example, Mr. Z, a non-resident person, we have an example. This is that a non-resident person sells its shares to resident person. So the according to valuation of the shares by the SEBI, as per the SEBI guidelines, is rupees 200 rupees. So you can issue, Mr. Z can sell his shares below the price worked out with the SEBI guidelines. So they can sell the share below rupees 200. And in this picture, Income Tax Act 11 Section 11(UA) comes into picture. If that price is also worked out with 190, then there is no issue. But if the price worked out with Section 11(UA) comes to rupees 210, then we have to keep in mind both of the provision, and we have to issue. We have to decide the price. Which price of the equity instrument which is sold by the foreign investor. Now, the third point is where there is issue of the shares through the subscription to the memorandum, then the valuation report is not required and the value of the price is face value of the share. Now, there are various forms which are available in the portal. So there are various forms required to file where in the specified scenario. So the FCGPR form, RBI has launched a new site, that is forms.rbi.org.in, in which we can file all the format single tab. So SMF form, that is single master forms, where through which we can file any of these forms. The form is like FCGPR, that is the form when the company issues the equity instrument to the foreign resident person, the FCTRS is the form when there is transfer of equity instrument between resident person and non-resident person. LLP1 is the form which is to be filed by the LLP when LLP received the foreign direct investments as a capital contribution, or LLP2 is the report where there is transfer of capital contribution, or even if you are sharing the profits to the foreign investor, then also LLP2 is required to file. Then Form CN, if convertible note is issued to the foreign investor, non-resident person, then Form CN is to be filed by the entity, Indian entity. Form ESOP is required to file when the domestic company, Indian company, providing ESOP option to the foreign employee resident outside India. Then Form DI, downstream investment. This is the form when reporting of downstream investment is there. So what is the downstream investment? Downstream investment means जब कोई Indian entity, suppose हमारे continuous example में ABC Private Limited has received the foreign investment to Mr. Z. Mr. Z is a non-resident person who has invested in ABC Private Limited. So when ABC Private Limited invest in another Indian entity, that considered as downstream investment. So if there is downstream investment, then Form DI has to be filed. Then Form DRR, issue for transfer of depository receipt to the person resident outside India. Form INVI, that is the units of investment vehicle issued to the person resident outside India. Now, which form is applicable? When there is person resident outside India invest in the company, then there are two forms, FCGPR and FCTRS. Both forms are required to file, applicable form are required to file by the company. So which form is required to file, that we will discuss. When there is inflow of foreign currency, means company जब कोई नए share issue करते हैं या तो फिर कोई already existing resident shareholder transfer करता है अपना share non-resident को, then in that case the inflow of foreign currency and company has to file the FCGPR form. And when there is when company issues the fresh issue of the instrument, then the FCGPR is to be filed. And when there is transfer of shares by the resident person to non-resident person, then there is FCTRS form has to be filed. And also when there is transfer vice versa from non-resident to resident, FCTRS form is to be filed. So only in one case, when there is new issue of shares, the FCGPR form is to be filed by the company, Indian entity. In the same case, the LLP in limited liability partnership, when the foreign investor invests in the capital contribution of the LLP, then LLP1 form is to file. And when foreign investor disinvest or its transfer its capital contribution or change in the profit or sharing of the profits, then LLP2 form is to be filed. Now, what is the time limit for this compliance? So, FCGPR for filing of the form FCGPR, 30 days from the date of allotment of shares. So, allotment of shares का time limit क्या है? Allotment of shares should be within 60 days from the receipt of the fund. So, for example, Mr. Z has transferred the amount in the 1st of October. So, within 60 days, till 30th November, the company have to issue the shares to the foreign investor, and at the time of on the date of the issue of the shares, the limit of 30 days is considered for filing of FCGPR form. So FCGPR should be filed within 30 days from the allotment of share, and FCTRS form should be filed within 60 days from the transfer of the share or the date of remittance, whichever is earlier. Now, first of all, जब foreign investor invest करता है foreign कोई Indian entity में. So what are the documents that we have to get? What are the main documents that we need to check? That is FIRC, which is required also for the filing of FCGPR form. FIRC and KYC of the non-resident person. FIRC from the bank is the must document which is required, which specifying the non-resident person's name, amount, and the purpose for which they have invested. So they have invested for the capital contribution, obviously. That purpose is also to be mentioned in the FIRC form. Along with that, the KYC of the non-resident person is also required. वो KYC of the non-resident person, why it is required? Because the government wants to know who is investing in the Indian business. वो सही है क्या उसकी? And that is also for the safety of the Indian business. Suppose कोई person है जो if you are not providing KYC in the proper format, then the form filing will not be accepted. So both these documents are required. Now, what is the filing procedure for FBI? For filing of the form, we need to first register. सबसे पहले हमें वो साइट पर रजिस्टर करना होगा. The site is the forms.rbi.org.in. तो साइट पर हमें रजिस्ट्रेशन करना होगा where all of these forms are available, FCGPR, FCTR, LLP1, LLP2, etc. Where we have to register on the site, and there are two-step registration process. First is entity user registration and second is business user registration. So both are one by one procedure. First step we have to comply, and after completing first step, we have to register for business user registration. So while registered for the entity user registration, which requires the basic details like name, PAN, address, SIN, authorized persons, SIN number of the company, and who is the authorized person, and the authority letter. Authority letter should be in the specified format only, along with the PAN of the authorized person need to be attached over there. So both these documents, PAN card copy and the authority letter, both should be attached at the time of registration. And after registering, when you will get the credentials, you have to log into the portal, and we have to enter the basic details of the entity, and we have to create a profile where we have to enter the basic details, particulars, and foreign investment information, means who are the foreign investors and what are the paid capitals and type of the foreign investor, that is their NRI or foreign person resident outside India or others. Then what are the types of foreign investment? That is the instrument which we have issued. इसका date क्या है? कितने number of instrument, कितने equity shares हमने issue किए हैं? All the details we have to enter over. Then second step is the business user registration. Business user registration may be seen. Every details we have to enter basic details, and we can create the business user credential. But what is the difference between entity user and business user? So entity user जो है वो वही entity को register करना है who have received the foreign direct investment, and the business user is for filing of these forms. So any individual or entity can register themselves in business user registration. So all the filing of form will be done through the business user credential only. We have seen the FCGPR form when it is required to file when a foreign investor invests in the business of the Indian entity, and the Indian entity issues the allot of the equity instrument. Then FCGPR form is required to file by the Indian entity. So in FCGPR form can be filed through business login only, and there are 5 tabs in which you can we have to fill the details. You can share. You can review the screen. As after login, there are 5 tabs: issue details, foreign investor info, details, amount of issue, particulars of issue, and the shareholding pattern. This is the form after. This is the page which we can see after logging to the portal. So there are five tabs. In issue detail, we have to enter the date of issue. Means हमने कब share foreign investor को share issue किया था and the nature of issue, that is the equity shares or convertible preference shares or convertible debentures, compulsory convertible debentures. That are the nature of the issue. Foreign investors detail. Second tab is foreign investor detail. That is the main tab. That is the main tab where we have to enter the details. बाकी सब जो 5 टैब है, 5 में से ये सेकंड को छोड़ के बाकी सब बेसिक डिटेल्स वाले है. द मेन टेब इज फॉरेन इन्वेस्टर डिटेल्स, जहां पर हमें डिटेल्स ऑफ फॉरेन इन्वेस्टर का नाम, एड्रेस, इश्यू ऑफ द इंस्ट्रूमेंट, इसका डिटेल्स मतलब कि टाइप ऑफ इंस्ट्रूमेंट, नंबर ऑफ इंस्ट्रूमेंट, इसका फेस वैल्यू, प्रीमियम एंड द इश्यू प्राइस एंड हाउ एंड द मोड ऑफ पेमेंट. फॉरेन रेमिटेंस सर्टिफिकेट से consideration is received or consideration received from the NRE account or external account, which are the types of mode of the payment we have to report over there. Then the amount of issue. Third tab is auto generated tab, which compare the total inflow. हमने कितना Indian entity को कितना foreign inward remittance, कितना foreign currency involved हुआ है, and how much they have issued the how much amount they have issued as a capital instrument, equity instrument. So both the values shall be compared over there in third tab. The particular authorization report जरूरी है, required है, so we have to attach over there. In case when there is required, in any other case, the valuation report is required. Then the fifth tab is also auto-generated, auto-populated tab, where shareholding pattern is showing. Means the pre-transaction shareholding pattern and the post-transaction shareholding pattern. क्या change हुआ है, कितना foreign investor में holding है और कितना Indian investment है, that will be reported over there. And all the documents which have to be attached in the fifth tab. So what are the documents? कौन से document हमें attach करना होंगे in this FCGPR form that we will discuss. Documents which are required to be attached is the first and foremost is the FIRC, that is Foreign Inward Remittance Certificate, which is most important document. Then the valuation report, other valuation report required, and we have to attach that also in a separate tab as we have discussed. Declaration by the investing company that it has complied all the compliance, all the requirements, and a certificate from the CS, company secretary, that the Indian entity has complied with the FEMA regulations and company law regulations. Then board resolution. The board resolution which stating that they have issued the share to the non-resident person. There is number of shares and how much amount of shares. All will be stated in the board resolution, and it also has to be attached over there. Then memorandum of association if it is applicable, and the KYC of the resident person outside India, which is most important, attachment with regards to the FCGPR filing, and it should be in the specified format only that FEMA have provided. This format is provided in the FEMA master direction. After submitting form, the form will be auto-populated, and in 5 days, the ID bank will process the form and they will inform to us whether the form is approved or not. So there can be, if all the documents are proper in specified format and all the details we have filled up is proper, then they will approve the form, or otherwise they can reject the form if there is any error or documents are not in specified format. So they will reject the form. Then we have to file all this procedure. We have to comply all this procedure. We have to file FCGPR form again, and in the second time filing of the same form with the same detail along with the correct document, the days of 30 days from the due date to file the FCGPR form, we need to keep in mind that within 30 days we have to file that form FCGPR. Now form FCTRS. When the foreign investor transfer its shares to the resident person or vice versa, the form FCTRS is required to file. All these forms, as we discussed, FCGPR, FCTRS, LFT1, and LFT2, all these forms can be filed through business user only. And there are three tabs, plus last one is the auto-populated tab. The first step is the common detail, where there is transfer by way of sale or by way of gift, or transfer from. Transfer from means the transfer from resident to non-resident or non-resident to resident. Which are the types of transfer? Then date of transfer, nature of transfer. We have to provide all these details, basic details in the first step. Second is the particular of transfer. So we have transfer, non-resident person have transferred the equity instrument. Either they have sell from the resident, or they have purchased from the resident person, or they have sold. So what are the types of instrument? How many number of shares they have sold or purchased? What are the conversion ratio? What are the issue price, total consideration? Every detail, each and every detail of the transfer, you have to mention in second. Then third is the remittance detail, means how the non-resident person have paid or received. So mode of payment, details of ID bank, कौन से बैंक से transaction हुआ है, उसका tranche number, means the whole consideration is paid in one tranche or there is paid in two tranche or more than two tranche. Then all the details shall be reported in remittance detail. And the fourth step, shareholding pattern, is auto-populated like complete transaction report and the post-transaction summary of the capital. Now, what are the documents is required to attach? जब हम FCTRS फाइल करते हैं तो कौन से documents required है? So there are actually three types of transfer of shares. Either कोई तो gift कर सकते, gift transfer by way of gift, or transfer by way of private placement, or transfer in the stock exchange. Transfer of shares in the stock exchange. So first is transfer by way of gift. If it is transfer by way of gift, so the documents required is KYC of the person, foreign investor, KYC of the foreign investor in all the cases it is required, relevant regulatory approvals, consent letter. If it is by way of gift, so donor and donee का consent होना चाहिए कि उन्होंने gift किया है, फिर बाद में अगर वो gift is not a transfer by way of along transfer against the consideration रहेगा, तो that consideration नहीं होना चाहिए. That's why the consent letter was required, that it should be if the foreign investor transfer its shares which they have acquired earlier by filing FCGPR form, then FCGPR form का reference number यहाँ पर हमें रिपोर्ट करना है, acknowledgement इसका अटैच करना है, and the valuation report. The documents अगर हमने private placement से सेल किया है, that is private company में अगर कुछ शेयर ट्रांसफर हुआ है नॉन रेसिडेंट टू रेसिडेंट और रेसिडेंट टू नॉन रेसिडेंट, तो वो केस में एमसीए की साइट पर जो हम फॉर्म फाइल करते हैं SH4 शेयर ट्रांसफर एग्रीमेंट, वैल्यूएशन सर्टिफिकेट, नॉन रेसिडेंट डिक्लेरेशन. In case of sale by non-resident, non-resident sell कर रहा है, that means they have acquired earlier. So उन्होंने पहले जो acquired किया था वो टाइम पर जो फॉर्म फाइल किया है FCGPR और FCTRS, इसका acknowledgement number, then FIRC or outward remittance certificate, no objection certificate from the income tax authority, and if it is from approval groups, then government approval is also required. Third case is जब foreign investor foreign investor transfer अपने share transfer कर रहे हैं on the stock exchange, either purchase or sell on the stock exchange. So for sell or purchase on stock exchange, the contract note should be attached as transfer agreement valuation certificate. Broker's note shall also be attached over that, which specifying the date of transfer, settlement, number of shares transferred, list the basic detail of the transfer of the instrument. Then non-resident declaration, outward remittance certificate, copy of the acknowledgement of the earlier filed FCGPR or FCPRS. Whenever there is transfer by the non-resident person, that means they have acquired earlier. So obviously the earlier filed form का acknowledgement भी यहाँ पर लगेगा and no objection certificate. Now, these are the forms FCGPR, FCPRS, LLP1, LLP2. That is the form which is required to be filed at the moment of the happening of the event. So, जब ये transfer होता है, तब ये forms file करने होते हैं FCGPR, FCTRS, LLP1, form CNDR. But what are the annual compliance when there is foreign inward remittance or outbound investment? So there is annual compliance which needs to be complied by all the Indian entity. Either they have received the inbound investment or they have made the outbound investment, means the Indian entity has invested in the foreign company or foreign business. So inbound investment or outbound investment, दोनों में से कोई भी रहेगा, then Indian entity has to file the foreign liability and asset return, FL return. So this return has to be filed within due date, that is 15th July, after completion of the financial year. And this form is filed online through the portal, Flare RBI portal, flare.rbi.gov. On that, we have to register first on the online portal. At the time of registration, we require two documents only: the authority letter and the verification letter in the specified format. After registration, FLA return can be filed online on this portal, and there are mainly 5 sections. So, section 1 is talking about the basic detail of the Indian entity. So, the name of the entity, PAN of the entity, scene of the entity. Then there are capital structure of the entity, then face value of the instrument, and there are basic details which required to file section 1. Section 2, जहाँ पर हमें report करना है financial results, means the profit summary, profit and reserve summary of the Indian entity, net worth of the Indian entity, profit and sell and purchase of the Indian entity, that is the financial result, and the number of employees. In the third case, when Indian entity has received the investment, means there is inbound investment, received the foreign investment, then we have to report in section 3, where the investment made in India with the value and its trade liability we have to report. So, suppose ABC Private Limited has received an investment in the capital from a foreign investor, then they have to report in section 3 financial liability. And if ABC Private Limited has made foreign investment, has made investment in the foreign company, another foreign company, इसमें invest किया है, then the investment in outbound investment will be reported in section 4, financial asset. Investment made outside India with the value and its trade receivable in the foreign currency, etc. And section 5 is variation report, which is auto-populated report in the online portal, and which shows the comparison of the current year with the last year. Here, the points need to keep in mind is that the net worth in section 2 is considered only the participating preference shares, means the non-participating preference shares will not be considered in net worth. If there is non-participating preference shares, then it will not include in the net worth of the company. Yeah, important point section 2 में participating preference shares which considered in net worth and non-participating preference shares which will not be considered in net worth. Here, in section 3, the main reporting criteria is that if you have received the liability from the same foreign investor, then you have to report along with that table only. And if you have received the foreign liability, means trade liability or anything else from the other investment, from the other person, then it shall be reported in the last table 4. And the investment in debentures, if there is investment in debentures by the non-resident person, then we cannot report it in the equity instrument because debenture, convertible debentures, non-convertible, redeemable debentures cannot be considered as equity instruments, and this cannot be reported along with the net worth. We have to report it separately. Now, in inbound investment, foreign person resident outside India either can invest in the business or they can invest in the property also. So they can invest in the property, land or building or property, immovable property in India. So only or of the securities they can invest in securities also. Only NRI and PIO are allowed to acquire the property in India. So, but the agriculture, they cannot acquire the agriculture property. Yes, they can inherit the agriculture property, but they cannot purchase the agriculture land or property from the resident person. If their foreign spouse of NRI or PIO can become joint owner also, subject to their marriage to be sustained for 2 years. NRI and PIO can inherit the agriculture property from a resident, but if they have acquired the agriculture property, NRI or PIO have acquired, they can sell only to the resident person. They cannot sell to NRI again the agriculture property. Other than agriculture property, yes, they can sell to the resident or non-resident. Resident can gift the property also to NRI or OCI, obviously other than the agriculture land. And NRI can gift any property to resident. NRI can give NRI resident to sell the land, then there is no restriction of agriculture or non-agriculture. But if we are transferring property to the NRI, then there is restriction of the agriculture property subject to this laws. Now, remittance or sale of the property. Amount brought in by way of inward remittance from the outside India, only by way of banking channels it can be remitted. Can be remitted over and above the 1 million scheme, but subject to the maximum of 2 residential property is permitted. And the transfer of this is regulated by the FEMA acquisition of immovable property in India regulations 2019, and the sale proceed must be net of taxes can be remitted after payment of the tax. Here I conclude my point, and the FEMA has liberalized its transaction in many ways, and through which the Indian entity got the foreign investors, got the foreign capital in the Indian economy, and by which the Indian economy has been grow. So inbound investment and outbound investment both lead to the growth of the economy. And as a professional, we need to comply with all the compliance and the regulations we have to comply with, and it is a great responsibility on us. So we have to take care all of this while filing these forms. And I would like to thank you all of you present over here. If there is any question, yes, we can discuss.
Yeah, okay. Thank you so much, Priyanki, and as well as Amar for the wonderful deliberations. And there are questions. So just wanted to know if you both would be taking up together, or should we go one by one?
We can both take up.
Okay. Okay. At the outset, sincere thanks for the wonderful slideshows prepared as well as the interactions. Thank you so much.
Thank you.
So should we start with the questions?
Yes.
Okay, so under LRS limit is USD 2,50,000. But what will be the procedure if individual wants to invest more than the prescribed limits?
You will have to take approval, RBI approval for that. Because within a financial year, if he's making an ODI, he can only invest up to 2,50,000 USD per financial year. Otherwise, you'll have to go for an RBI approval.
Okay, so is there any checklist for remittance to foreign partner for technology transfer?
For foreign transfer, as in for services?
Technology transfer. Checklist for remittance to foreign partner for technology transfer.
We check
I'll
and
have to
Is there any such
check into
checklist
that.
as such?
There's no such checklist, ma'am. I'll have to
Okay.
check into that.
Okay, okay. What extra caution is to be taken regarding submission of documents in order to avoid freezing of account and levying of penalties?
Ma'am, all the formalities have to be done on time. As we mentioned, the share certificates, once you have done the ODI, the share certificates have to be submitted to the bank within 6 months. Your APRs, FLA have to be done on time. FCGPR has to be done within 30 days. So all your formalities, if done within time, there is no penalty, no problems.
Okay. In ODI investment, can one get allotment of equity shares other than cash?
Other than cash, as it, ma'am? By swap is there.
Swap. Okay. The other query is related to filing of Form FCTRS. Could you please clarify, number one, who is responsible for filing the Form FCTRS when equity shares of an Indian company are transferred by a foreign company, that is the shareholder, to a resident person, and resident person transferring company?
FCTRS form is required to file by the Indian entity जिसके शेयर ट्रांसफर हो रहे हैं वो इंडियन एंटिटी इज रिक्वायर्ड टू फाइल फॉर FCTRS.
Okay. And the second question after this was from the same, whose customer KYC we have to obtain for filing the FCTRS in RBI firms portal?
KYC of the non-resident person is required in the specified format only. The specified format is provided in annexure of the master direction, and it should be from the non-resident person. It is of non-resident person.
Okay. Will it be considered as a control if equity participation is less than 51% but without voting right?
No, for control, 10% or more voting rights should be there. Or if they can control the management and if they can control the policies and the directors, more than 50% of the directors and they control the policies, then you can exercise control that way. But
Okay.
for shareholding, the voting right should be there.
Okay. The next question is, can a company prepare audited financial statements as on any date other than the year end in the middle of the year for the specific purpose of making ODI?
Yes, it should, because it says audited financial statements. It does not say as per the statutory, as per any statutory act. So if it is an audited financial statement, it should suffice.
Okay. The other question is whether the limit of 400% of net worth has to be checked for each year separately, whether such limit applies to all the investment made.
Yes, yes. For any investment made, you have to check the 400% limit. And even in a particular year, if you're making 2 or 3 remittances, while making the ODI, you have to check that the financial commitment comprising of this proposed ODI is not exceeding 400% of the net worth.
Okay. So it has to be checked every year separately.
Every transaction, every ODI.
Okay, okay. What if an Indian LLP has done ODI but is not under audit? Then how to share the certificate from the statutory audit?
He'll have to get it audited.
Okay. The next question. Yes, Priyanki, you are adding something?
It has to require the audited statement.
Okay. Okay. The next question is, in case of investment made by individual under LRS, the TCS will be deducted from the amount remitted or can be paid separately by the individual. Example, if an individual wants to remit 2 lakh USD for subscription to shares in overseas company, then whether it will be deducted from 2 lakh USD or the amount remitted will be 2 lakh USD and individual will deposit TCS amount in INR separately.
The bank will pay that amount.
Okay. Whether 400% limit will apply to all types of investment, that is equity, bonds, loan, etc. And what are the rules for portfolio investment abroad?
Yes, the 400% will apply to all, to equity, debt, everything. And even if an Indian entity has done equity transaction and a debt transaction, for every, you have to include all your equity, debt, guarantees, all for that 400% limit. And for the overseas portfolio also, they have in the rules and regulations, they have defined how you can go about it. So in 2022 declaration, they have given that. They've given a small paragraph regarding the same in the 2022 rules, regulations, and directions for overseas portfolio. No, actually, I cannot hear you, ma'am.
Audible now?
Yes, ma'am.
Oh, okay. Whether the 400% limit that we have discussed already regarding the portfolio investment abroad, there are certain rules and provisions that require approval from RBI. Does that mean approval from AD Bank or approval from RBI through AD Bank?
Approval from RBI through AD Bank.
So what is the process of taking such approval?
You have to go to you have to apply to the AD Bank, and the AD Bank will further process the document and will send it to the RBI.
Okay. Okay. The next question is how to determine rate of interest at arm's length.
You have to see, you have to get, you have to see, when a person is making a making a loan instrument in a foreign country, he will notice what is the market rate. So he has to see similar instruments. Suppose if he's giving in a similar debt instrument, he has to see the similar type of instruments. Suppose if it's a debt instrument, so there will be a lot of depository receipts. So there will be a market rate trending for that debt instrument. And if you're giving a loan, so you can see the rate of interest for which a company can avail a loan in a foreign country. So that can be an arm's length.
Okay. Whether guarantee will be counted for 400 limit.
Yes, yes.
Okay. And 400% net worth limit is as per the financial year?
The latest audited financial statements. So
Financial statements.
as per the latest audited financial statement, ma'am. So,
Okay.
Suppose right now we are in May 2024. So a lot of companies' financial statements for 2023-24 may not be ready yet. So then you can use the financial statements of 22-23. However, this can be the financial statement of 22-23 can be used only up to 30th September 2024. On 1st October 2024, we have to take the net worth as per the financial statement of 2023-24.
Okay. So RI are not required to file APR FLA?
Resident individuals?
Huh?
FLA, they're not required to file FLA. Resident individuals are not required to file FLA. APR they have to file.
APR they have to file.
Yes,
Okay.
yes.
RI is required to file the audited FS of financial statements of foreign entity for APR and the CA certificate from statutory auditor or how it is?
See, ma'am, the APR has to be certified by the statutory auditor. The foreign entities accounts have to be audited by the auditor in the foreign country. We do not
Okay.
have to, the Indian auditor does not have to audit or sign the accounts of the foreign entity. It has to be got it done from the foreign auditor only. The the statutory auditor of the Indian entity, he has to certify the form APR. So management will fill the form APR as per the financials of the foreign entity, and the chartered account will check it with the financials, and he will certify the APR. He does not have to certify the financials of the foreign entity.
Okay. Okay. In case of a resident individual, can he make investment at higher than the fair value as per the rule 11 UA? I mean, is it mandatory to repatriate the profits earned by the foreign entity? And if yes, the time limit. If not, what are the reporting requirements? So this is in case of resident individuals.
Ma'am, are we talking about Making an investment or receiving back the repatriation?
No, making at higher rate than fair value as per rule 11 UA.
No, you cannot. See, ma'am, now there are two things over here. In FEMA, foreign exchange management, you cannot make an outward transfer more than the fair market value as per FEMA, because you cannot remit more funds outside than the fair value. In income, you can do remit less than the value. Suppose the fair value of the share of the entity is rupees 100, you can make an investment at rupees 90. That is okay, but you cannot make an investment at rupees 110. But what happens over here is, in income tax section 56 to 10 and rule 11, you have to calculate the fair value as per rule 11 US separately. And as per section 56 to 10, if I have purchased these shares at less than the fair value, then the differential will be taxed in India. It is allowed in FEMA. I can remit less than the fair value as per DCF method in FEMA, but if it is less than the 11 UA, it is more than the 11 UA value. If it is less than the 11 UA value, it will be taxed in India.
Okay.
So basically, you have to, as a consultant, you should check it should be either equal to or less than the fair value as per the discounting factor method, or equal to or more than the 11 UA method.
Okay. Okay. Thank you. In case of RI, the APR to be submitted should be as per the reporting period of RI, IE, or the accounting period of the foreign entity.
APR has to be submitted 31st December
Okay.
of the financial year. Suppose 23-24, we'll do in 31st December 24.
Okay. If audit is not prescribed for the foreign unit based on its size, are we still required to get its accounts audited for the purposes of APR?
APR. See, this situation we faced recently. Now they have gotten the definition of control. As mentioned, if an Indian entity exercises control over that foreign entity, then you require audited financial statements. Now, control definition is 10% or more. So, if an Indian entity holds 10% or more percentage in that foreign entity, he will have to get his accounts audited over there. In our case also, that company was foreign company was not eligible, not required to get its accounts audited as per their rules and regulations. However, because of our FEMA rules and regulations, we had to instruct them, you have to get your accounts audited, because they had 10% or more investment in them.
Okay. Okay. So if remittances are made from EEFC account, do we enjoy any exemption in the compliance?
Yes, you can make remittance directly from EEFC account, and the rules and regulations are not applied.
Okay. Valuation regarding the fair value, any monetary limit fixed beyond which valuation is must? And
No.
for face value investment on the initial capital of new company, is valuation required?
No, the first time because you're putting amount in some, you are subscribing to the shares, so that time no valuation requirement not be required.
Acha. So if value in question is also not so material also, then in that situation also, it will not apply in that case.
I didn't understand, ma'am.
For the face value investment on the initial capital of new company,
Initial capital, yeah.
if the value in question is also not so material, then also it doesn't matter.
No, ma'am. If it's the first, if you're subscribing to the, it is the first investment, you're incorporating a company in a foreign entity. That time valuation would not be required. But any incorporated entity, a company is already incorporated, and you are purchasing the shares of the foreign entity, then you cannot pay more than the fair value.
So all these above questions raised are for outbound investments only.
Okay. Yes, ma'am.
So this was the comment from that same member who had posted all the above questions. There is a compliment. There are many compliments, and it's flooded that about the presentation. It was really nice, and they have really appreciated the presentation. So thanks to everyone. They are also asking for the recording of the webinar, which I'm sure the committee will be sharing with them all. Another question that we have received just now, that what kind of additional approvals are required to be received from RBI for transfer of amount above the LRS limit, and also are there any other additional documents to be submitted or filed with it?
That, ma'am, I'll have to check on that.
Okay, no problem. So are there any restriction on investments with land bordering countries, and if they can invest through other entity?
No, directly or indirectly you cannot. If the central government has restricted, see, it's not land bordering countries. There may be any country which the central government has restricted. If you, for example, right now they've restricted to Pakistan, but they may restrict other countries as well. So if it is restricted, then directly indirectly you cannot.
Okay. So, end of questions which are received as of now. But I really would like to express heartfelt gratitude for all your time, effort, and knowledge shared, all the expertise that you have shared with all the participants. And I really take this opportunity to extend a heartfelt gratitude to both of you, Amar and Priyanki. Thank you so much for your time and the presentations. The participants have asked for the presentations. So, if you could please give a permission to share
Yes,
that.
ma'am. Yes, ma'am. Thank you, ma'am. It's a
Thank
wonderful
you, ma'am.
opportunity for us. You have given us such an opportunity and platform to express ourselves. Thank you very much for that, ma'am.
Thank you
Thank
so
you so
much.
much.
Yes, thank you. It was a really pleasure to reconnect and look forward to meet you sometime very soon at the branch as well. And I also take this opportunity to thank Chitare sir for this initiative and giving me this opportunity to moderate the session. I also express my heartfelt gratitude to all the participants for giving such overwhelming response. The chat box was running with the questions and compliments to both of the speakers. Thank you so much. I also thank the technical team for the technical support throughout the program. So thank you to everyone. Thanks to all the team members as well. Thank you so
Thank you.
much.
Thank you. Thank you, everyone.
Thank you.
Thank you.
Take care. Good night.
Good night, ma'am.